So when I heard that he was doing a session at ICOR a few weeks back, I would say, I thought it was a good session for our community, inshallah. I think both learning the dunya and the akhirah is of importance for every Muslim, and especially during this time with the April tax deadline. I reached out to Brother Hassan. I know him since our UW days at MSA, and so he was kind enough and generous enough to spend his time with us today, inshallah. And so I do want to give him the floor as it set out here. So apologies for the display.
بسم الله الرحمن الرحيم والصلاة والسلام على رسول الله اللهم علمنا ما ينفعنا وانفعنا بما علمتنا وزدنا علما سبحانك لا نحصي ثناء عليك كما أثنيت على نفسك لا علم لنا إلا ما علمتنا إنك أنت العليم الحكيم. بسم الله. So my name is Hassan. What I was hoping to do, so we did a presentation at ICOR, which is the mosque that's closest to me. And there's a lot of tax implications, there's finances, there's budgeting, there's forecasting, and I think we've all become acutely sensitive, I would say, to how our tax dollars are used, especially what's happening more apparently overseas. No one likes to spend money and give money to a government who uses it to kill our brothers and sisters. So I think that's first and foremost, which made this a little bit more relevant. There's also a practical element in terms of interest, and just some practical things we need to be aware of that are conventional but not appropriate Islamically. And there's also some things we can do to mitigate our tax responsibility. So, over here. So, in terms of an agenda, what I was asked to cover is taxation, financing, investment, and budgeting. So those are the four. I'm hoping we can finish about half an hour, and if you guys have questions, inshallah, we can try to answer those. But I'd like to make it interactive. So if you guys have questions on what's shown or I'm discussing, feel free to raise your hand or interrupt me. On the sister side, I don't know how you guys communicate or how that works, but they got a mic, even better. So that's how we do it. So try to make it interactive. I'd appreciate the engagement. And if something's not clear, let me know. So this is a list of taxes. So we're all aware of our federal taxes. We have some states have state taxes. There's Medicare and Social Security taxes. That's what's funding people who retired. There's sales taxes on everything that you purchase in the state of Washington. There's also local taxes. If you own a home, you pay property taxes. There's gas tax, that's why it's $4.20, $4.10, $4.40. It's much higher than other states because Washington State has a higher tax per gallon. And then the list just goes down. Businesses have D&O, they have personal property. And then off to the right, you have different situational taxes. There's actually a gift tax. If you give somebody more than $16,000, as a person giving, you pay taxes on that gift. There's a lot of interesting rules, technical rules. And this is, I don't know if you can see it because of the table, but there's a pie tax in Florida. There's what they call a sliced bagel tax in California. And what that is if you buy bagels, it's considered food, but as soon as you slice it, it's prepared food, so we tax it. Right, so there's all these nuances. There's a flushing the toilet tax in Maryland. Right, they have all these bizarre things within the tax code. But my point here is that you get taxed every which way of life. When you die, you're taxed. When you're born, you get taxed. Right? There's no escaping it. The question is, and we'll get to it, is how do you avoid some of it? And this is real, by the way. This is an IRS website. Income from illegal activities, such as money from dealing illegal drugs, must be included in your income. So even if you're going to be a thief and a criminal, you have to do your taxes right and report that you're a thief and a criminal and report that income. So technically, if you wage a bet with a friend and you win, he gives you something of value, you're supposed to record that value as income on your personal tax return. That's how technical it is. U.S. citizens and alien residents are taxed on worldwide income. Meaning if you have a U.S. citizenship and you make money in wherever home is for you, Somaliland, Pakistan, wherever, you're supposed to technically report that as income to the U.S. government for U.S. resident aliens. Now, whether they can track that and all will actually know about that slightly different, but technically, that's why in Canada, one person I audited his company, he revoked his Canadian citizenship and moved to the Cayman Islands. So he gave up his citizenship and moved to a tax-free jurisdiction and incorporated his company. Literally, it was just, he owned domain names. That's all he did. He owned domain names, and he had Google set up all the advertisements. So if you go to sa.com, whatever the website he owned, he would get some revenue from that, but he revoked his Canadian citizenship, moved to a tax-free jurisdiction, so that every dollar he was paid by his corporation would have zero taxation on it. So I'm not recommending you give up, but like people do things to avoid taxes is my point. And illegal, like the UK said about Amazon, they said, it's legal, but it's shameful, right? You avoided all the taxes possible. It's just shameful that you're paying 15% versus the average person, right? And that's when they get into the like Mitt Romneys of the world and the others and saying, my secretary pays more in taxes than I do. It's because of how their income comes in and how they live their lifestyles and how they structure certain things. But don't be illegal in criminal activities, but technically that's reportable. All right, so there's a difference here between what we're talking about and what's across the line. So one is, we're talking about tax avoidance, how to mitigate your taxes to the US government, perfectly legal. Tax evasion is how do I over-report expenses or under-report my income? That is illegal. So we're not talking about evasion, especially for whoever's listening, we're talking about avoidance, okay? And so one thing that's interesting is there are tax advisors who get paid a lot of money to these big companies and high net worth individuals, and what they do is they take aggressive tax positions and interpretations, and then after 3 years that pass, if they didn't get audited, they have huge parties. Because you just saved your client millions of dollars and they invited you, and now the IRS can't go after them. Because they took a very aggressive interpretation or position, and now they're free from being attested. That's different than committing fraud. The difference between fraud and a mistake is your nia. So even in the audit and corporate and IRS world, your intentions differentiate between it was a mistake versus I committed a fraudulent activity. Like, for example, I'll give you a personal example. We purchased a house, and when we did that, I borrowed money. You can borrow $20,000 from your IRA account. And what happened, and it's without a fee. Usually you have to wait till you're 59 and a half, but if you're buying a house and you're married, you can take $20,000 out and just pay taxes on it, but it's without a fee. And the reason that worked out was because our corporate, at the time, they would match some of your retirement, and eventually I could use that for buying a down payment on a home. But I forgot to report that I'm a CPA, right? But I forgot to report that $20,000 as income in that year. The IRS let me know 2 years later that you forgot to report it, and so you got to pay taxes on it, which was like $5,000, which was a pleasant surprise. But then it was like, and by the way, you've got to pay interest on the taxes you should have paid, you didn't pay, therefore we had a fee to it. So that was a little bit of solid wins. But my point is that that's a mistake, that's oversight. It wasn't intentional, avoidance of some sort of responsibility or income. The ultra rich, I kind of talked about that. It's how they take these net losses of their big companies and they can roll those forward 20 years, right? So that's one thing they can do. They can offset their huge losses or bets, and they can offset against current income. The other thing they do, so this is, again, primarily non-Muslims, right? They will live in debt. So instead of saying, I will liquidate my stocks in my company, I will just borrow money from the bank at a cheaper rate, and I'll use my investments, my stock value, as collateral for what I'm borrowing. So it's cheaper for me to live in debt and borrow money to support my lifestyle than to liquidate my stocks and pay taxes and capital gains on that. So that's actually what a lot of them do. So they use those and they get a tax break from the interest and all these sorts of things. But they live a lifestyle that's not W-2 income. Most of us are probably W-2 income, wage workers. They have different ways of getting their income, which are usually owning businesses. So we talked about tax evasion. So you guys know what Al Capone is? Is that a dated example? It's like, right, he's a mafia figure. It was during the time when they couldn't sell alcohol It's like pseudo-Islamic in America where they couldn't have alcohol, but they had underground ways of doing that. So Al Capone, if you know how he got arrested, it wasn't for killing all the other gangsters. It was for tax evasion. That's how they caught him. He ended up in Alcatraz. They passed a law during his time that said, there was that law that I showed you, if you have illegal activity, you have to report it, regardless of it being legal or not. And that was his famous quote, was they can't collect illegal taxes on illegal activity, but they changed the law during his time, and then they went after him. But it wasn't for all the, like they knew his fingerprints were on everything, all the crime scenes, but they couldn't pin him on it. And so they got him for tax evasion. So don't tax evasion. All right. Tax avoidance, why are we doing that? So this is, at least I'll tell you the Shafi opinion. Taxes are not permissible. They're not, a government is not allowed to take your money. So you have a contract with a company or another individual that says, I will pay you $100,000 or $50,000. An entity, a governmental entity, doesn't have the right to take some of your money, to come between you and that contract and usurp your wealth. So from a Shafi perspective, I was asking the Imam, I was Faqih lately, I said, what about 401ks? Like, how do I value my 401k from a zakat perspective? And I said, because when I have an IRA, so once I liquidate it, I'm going to have to pay 25 or some sort of tax rate on it. So do I take the value that I see, or should I reduce it by my taxes of 25%? And he said, Aslan, like taxes are haram, so you can't, it's haram for them to take it, but you can't reduce what you owe or how you calculate your zakat. You have to do it on the value that you see. You can't reduce it by something that they do to you that's haram. So the point here is that taxes are, it's your right to your wealth, so you should try to get as much of it as you can. The other obvious thing is, this is just a chart that shows which countries get our foreign aid. Obviously, front and foremost is Israel. So enough said about that. We don't want any dollar that we have going to what they do. And the last piece is, pay your taxes on time. You might get the advice to it. Has anybody, you guys know what an extension is? So April 15th is the deadline. Has anybody tried to extend? Raise your hand. Good. Okay. My brother, alhamdulillah, that's good. Low percent. Good. Don't do it again though. Yeah. Here's the problem about extensions, because most people say just extend, it's not a big deal. The problem with extensions is you're going to, on April 15th, unless you're owed money, then you're okay. But here's the problem. People will say, okay, well you have to make an estimated tax payment. So let's just say it's $5,000. I think I owe $5,000. So I pay $5,000, and then I'll do my taxes by October 15th, 6 months later. When I do my taxes, if what I actually owed was $4,000 and I overpaid the $1,000, guess what the IRS is going to do? They're going to say, here's your $1,000 back that you overpaid, plus you gave us some money in advance, we're going to give you interest. And then they're going to send you a 1099 that says, report this interest income on your next year's tax return. And if you underpaid, it was supposed to be $6,000 and not $5,000, they're going to say, owe us the $1,000 and then pay us interest on the $1,000 that you underpaid. So in either scenario, you're going to pay interest. Okay, so don't extend from that perspective. Does that make sense? Okay. Okay, now how to avoid taxes. First one, be married, stay married, and have tons of kids, right? What happens from a tax bracket perspective is you pay, it's a graduated taxes. So you pay from 0 to, let's just say 25,000, you pay at 10%. And then from 25,000 to 50,000, you pay this. But what happens when you're married, every bracket doubles in width. So instead of it being 1 to 25,000, it's 1 to 50,000 at the same rate. So you get half the taxation. That assumes that your spouse doesn't also make the same level of income that you do. Okay. Some brothers complain because their wives get like the part-time teachers, they get 1099s, and so the brothers are like, yeah, that's not so bad, I paid my taxes. But what they do is they tack their wife's income onto it that wasn't taxed, and then they feel like they underpaid. But it's usually because their wife's income, you can't go to your wife and tell her, hey, but you didn't pay your taxes, and give some money back. It's a rough conversation. But the point is that usually you have to expect that you're going to be taxed, especially on 1099, because no taxes are withheld on 1099. You pay it all at the end of the year. But here's something, so marriage, start a business. Here's an example. The guy who owns a property next to me, he's an accountant himself. And he goes, he was telling me he owns this yacht. All right, nice. And he showed me, it was in a magazine. It's like this nice, fancy, old yacht. And he goes, sometimes, every year, I have my clients meet me in Alaska. and I take them for a couple days salmon fishing. So what does that do? I have a personal yacht. In fact, during COVID, I said this is a business thing, so I could cross the border and you couldn't, right? Because they closed the borders, unless you had economic and business reasons. So this is a business. He has a personal yacht that he uses, let's say, 96% of the time. And that yacht's probably expensive, and it has a lot of value that you're going to depreciate. Okay, you depreciate the value of it, you take it as an expense, but what kind of expense is it? It's a business expense. Why? Because he takes some clients a couple times a year to catch some fish, right? So what he's done, in no other scenario can you take your personal items, cars and yachts and boats and houses, and create a business expense unless the fact that you have a business. Does that make sense? In fact, people do that intentionally. So what do? Some companies, when they have their sales organizations, what do? They have what is called like winner's circle. If you hit your numbers for the year, you go on a trip to Hawaii or Mexico. But what do? Because if the company just takes you to Hawaii and gives you glasses and gives you all these ATV trips and stuff like that, that becomes income to you as an individual, right? It's compensation. We pay for all these things for you just for this benefit. But what do? Like, no, it's a business expense. Why? Because we have a meeting during that fun festivity. Like, we created a business reason to justify why all those other things aren't taxable. We couldn't do that for the ATV, the scuba diving, but at least for all the other room and board and the house, like all the other events, we have at least a business purpose, so we justified it as not being taxable. You get the point, right? You can take personal events and tuck them under a business, now they become business expenses, right? Unless you have a business, you can't do that. The other piece, so investments. You guys know what anybody have investments here? Some of you guys? Half of you guys? None of you guys? Okay. So, short-term versus long-term. Short-term, you get taxed at your taxable rate, just like it's W-2 income. But if you hold it for a year or longer, it's at a 10% tax rate or a 15% tax rate. So that's the capital gains. Okay? You pretty much always want to hold things for a year. Aside from a long-term investment idea, it's a lower tax rate for you. So holding investments for a year or more is super important. Okay? There's other things, so qualified dividends versus non-qualified dividends. I don't think I need to go through the list. House, this is a true story. There's a person, at least this is told by a professor, there was a person who would go buy a house, live in it for a couple of years, sell it, go to the next house, live in it for a couple of years, sell it, go to the next house. And what he was doing is he was taking advantage of an IRS rule that says, if this is your primary residence and you're married or not married, you can have tax-free income on the gain. So if you're married, it's $500,000. If you're not married, it's $250,000. So what this person was doing is he was living in a house, letting it appreciate a couple $100,000, and then he was selling it, buying another house, letting it appreciate a couple $100,000, and selling it, and he just went through a cycle because all of that gain was tax-free. So as long as it's your primary residence, in fact, there's a threshold that I lived in it, I bought another house, but as long as I sell it within a certain time frame, even if I rent it out for a year or two, I can still treat it as my primary residence and let it keep appreciating. So that's one thing. Do you guys know what a DAF is? Donor Advice Fund? Alright, super important. If you have appreciated things of value, namely stocks, a lot of the mature charitable communities all use DAFs. So a DAF is a donor advice fund. There's 5 benefits. So what does it do? A DAF is where I'll use myself as an example. I have Charles Schwab as a broker, right? And I got some stocks from my company. Let's just say it went from $100 to $200. I can either sell the stock at $200, it's going to get taxed, so now it becomes $150 at best. And then I take that $150 and give it to the Cham refugee community as a donation on my way out, in cash. Most of you guys donate in cash? Okay, totally the wrong. So I can do the so what happens? I gave $150, right? Here's what a DAF would do. A DAF would say, I have that $200 of stock, and let's do it, I held it for a year. What I do is I open up a donor advised account, which now shows up in my same main page, my Schwab account, and I actually transfer that share over to my other account. And it liquidates, and it shows up in cash, and I'm going to put it in a fund temporarily, but it's $200 over. And when I say, okay, now that $200, send a check to the Chan refugee community. Okay? So what happened when I did that? I now have a charitable deduction of $200, not $100, right? That's the first benefit. The second benefit is that the community got $200 and not $150, right? Otherwise, my scenario, I basically, that $50 difference, I have a choice. I can give it to the IRS government, or I can give it to the not-for-profit. Those are my two choices. Doing it through a DAF allows me to give the full value to the organization and avoid taxation.
Will that work with company match too?
It does. So what happens is, so if you look at Benevity, for example, so what happens is, if you do that, they'll issue a tax receipt. So like, I shall check reads here. So I owe some money to their organization for relief, and so I do that through a DAF, right? So, and then I send him an email and say, hey, make sure this money gets to the Seattle chapter because it's going to New York, right? Because the address of where it's sent. But what I'm doing is, I haven't done it yet, but I'm waiting for the tax receipt. Like, if I have it, I think it's waiting to be processed. It's on its way. But this is a timely example. So I pledged an amount from the last fundraiser, and now I'm going to get a receipt that says the Hatem Family Charitable, certain amount on this date, here's your receipt, it went to this organization. So I go to Benevity and I know if my relief is matched, and I'm going to send that as my tax receipt. And so the third benefit, does that make sense? So you're going to get a piece of paper document that says you gave this, it's like a tax receipt. So the third benefit is when you do your taxes, like you get a million emails about all the different organizations you gave to throughout the year, right? You have to collect them all and see if you want to itemize or not itemize. The third benefit is all through one place. So because you centralize your giving, right, it's all in one place, and you're technically not supposed to get a tax receipt. So April Relief should not send me a tax receipt, because Schwab will, for everything I gave during the year, right? Yes?
Is the DAF similar to a trust fund?
No, it's different. Yeah, very different. So a DAF, here's the fourth benefit. What you put in the DAF is not subject to zakat. And here's why. Because I own my brokerage account. And what I'm actually doing is I'm transferring money over to a Schwab's not-for-profit organization. And then why it's called an advisor fund is because then I'm telling that not-for-profit, it's irrevocable, and this is why it's not eligible for zakat, is what I transferred over there can never come back to me. It's only given. And now it's not even in my authority anymore. It's in Schwab's, but I can advise them where to give that money. Does that make sense? Yeah. So that's why it's excluded now from zakat. So that's the fourth benefit. The fifth benefit, I can do this on the 31st of December, so I get the current year tax benefit, and then when Ramadan comes, I'm going to do my giving. So I can give to the not-for-profit, but then what happens is I can dictate the timing throughout the year. So those are the 5 benefits of the donor advice fund. So for those who give in cash and have appreciated stock, open up a DAF. It might be like $100 fee a year, but like the tax benefit, it way outweighs the cost of it. Does that make sense? The DAF fee is super important? Okay.
So personally, would you rebuy the stock, or are you going to keep it for some reason?
What do you mean?
Like, because you still want the stock, right? I mean, you're doing it to save money.
Oh, so
Personally,
you could, so yes, at one point I did that. I replenished. Yeah. So what happened was, let's say the stock goes like this. Yeah. Well, I'm going to give it at this point, but if I think it's still going to do this, I'm going to buy it again. And basically I replenish the number of shares, although it's going to be like for like. But instead of using cash, and then I'll do the same thing. That stock will go from here a year later, I liquidate it. So I did do that where I always wanted to replenish the basis of what I had. Yeah, so the number of shares could stay the same. If you need the cash for different reasons, that's different. But yeah, you can replenish it as well. But don't give cash if you can avoid it. Okay, so the other stuff.
When you say don't give cash, what does that mean? Just
mean that if you have
cash.
Yeah, so if what's liquid in cash? If you have on condition, if you have appreciated stocks, okay, or and it might be cryptocurrency. I don't know about cryptocurrency, but if you have appreciated assets more than a year, Don't liquidate those through a DAF. Don't liquidate them, pay taxes on it, and then give the remaining cash to an organization. So it's on condition that you have that scenario. So for example, when I was speaking to the brothers at Redmond, a lot of them work for Microsoft, for tech companies, and so a lot of them fell into that bucket. And so one of the brothers was like, yeah, this is like, I can't believe I wasn't doing this. Like for years and years and years, I was giving thousands of dollars away, but now I do everything through this app. But those are the 5 benefits. The timing, the zakat, the single receipt, the benefit to the organization, and the benefit to yourself. So the Mormons, for example, like they do it, this is how they give. Right? So mature organizations here that are charitable, their individuals almost all go through these avenues. Okay? The one thing that I will say as a caveat is that Fidelity, for example, does like electronic wire, right? Whereas Schwab does a check. So you just want to make sure if you're giving zakat, that you can notate this is the purpose of what I'm giving for. But in Schwab, they can say they actually have zakat, they have zakat al-fitr, they have like they actually have the categories, or you can write it in. Okay, so if it's for orphanages or it's for the men's shelter or women's shelter, you can actually specify that. Who's got retirement accounts? Everybody know the difference between IRA and Roth? Yeah? So post-tax versus pre-tax, which one's better?
Depends.
They say Roth?
Depends.
Depends on what?
If your tax bracket is going to be better later on or at retirement or no.
The only thing, so what's the difference? On IRA, I put $1,000 in, it's not taxed. It grows plus it grows, and then I pay taxes on the principal and the growth when I take it out. A Roth, I pay taxes today, but the growth and the principal I don't take out until I take it out and I don't pay taxes on it. Okay? So do I delay the taxation or do I pay it up front? So what Sophie is saying is that the only thing that matters is your tax bracket today versus the tax bracket you think you'll be at when you retire. So most people will say, well, I don't think I'll need to make as much income when I'm retiring. And so if the government doesn't change brackets, I think I'm going to be at a lower tax bracket when I retire. So therefore, I'm going to delay paying taxes until I retire. Right? That's most of the cases. The other benefit, if you want to use some of that for, some companies will say you can take 50% out for a down payment. Or if you have an IRA, you can take up to $20,000. So if it's not taxed, you have more money to take out for your personal, or it could be for education. Right? There's other reasons you can take the money out, but if it's not taxed, there's just more to take out. But if it's not taxed, you also pay more to take out. So a little bit of trade-off. All right, so that's the difference. Trust funds. So the problem with the trust funds at Coverdale, I think a lot of them don't have Islamic investment options. So it's challenging to find a good option. But you can do other things. Obviously, you can do other things. Like some 401ks allow you to invest like in Amana or Blanket or some of the more Islamic options.
Can you talk about the point 8 about fully funding your HSA?
Yeah, so HSA, so you have to have a high deductible account, which is essentially saying, I'll pay the first $3,000 of expenses, and usually a company will say, okay, we'll help fund you, like half of that in cash in January and then in June. And then they'll kick in, insurance will kick in, but you pay the first $3,000. That's a high deductible account. What they really want you to do, it can be I always do that, it can end up being cheaper, but they want you to change your behavior. They want you to say, I'm paying for it, therefore I'm not going to get that massage. Like, sweetie, you don't need that. Like, they want you to not spend, right? Because you're feeling that you pay the first $3,000. But the way I look at it is like, let me just burn through the $3,000, and then I'll feel like I'm getting 90% benefit when they're paying for it, right? So what happens, there's a limit, I think it's around 8,700 maybe. So if you don't fully fund it, you can end up treating it like an investment. So let's say you don't fund it so you put money into it. It's like a savings account that's tax-free. But if you only put 5,000 and you can go up to 8,000, you can put another 3,000 in it and roll it over to the next year and treat it like an investment. So it's like an additional tax-free way of investing.
Yeah, what about the trust fund? I know some people, they have trust fund when they put their house in there. So when they appreciate and they give the house to their children, there's no tax on that.
Yeah, so that's above my pay grade. But there is the trusts get really complicated because, so I mentioned there's a gift tax, right? If you give 15,000, 16,000 to, so what they do is they want to avoid an inheritance tax, right? An estate tax, which is like I die and there's going to be like a 30 or 45% tax on everything in my estate, and then my kids will get whatever. So what they're trying to do is before I die and during my lifetime, I'm going to give you $15,000 to each of my kids a year, so it's not gift tax. And then on top of that, I'm going to create a trust that I put these assets in, and once you're 18 or whatever age you stipulate, then you'll get some of these assets and they'll reduce or have no taxation to them. So that's what they're trying to do, especially like houses on the, houses now, they put them through because like, well, if I'm going to die, assuming you're not going to sell it, because what are you doing? You want to move state?
You want to transfer your house to your children, and they won't. So they don't have to pay.
Yeah, that house. Yeah, you got to be living in that house for a while, right? Like, your kids are 8 years old, you got to be at least there for 10 years old. But like, that's long-term planning. So people end up doing that when they're usually high-wealth individuals, and as they're seeing their own demise around the corner. Otherwise, you got to be like, this is my lifetime. I'm not leaving from this place ever. Because otherwise, planning around it, taking things in together, some of it's irrevocable. Once you put it in a trust, it's in a trust. And so then what happens if you want to liquidate when life events happens or divorce or whatever, right? There's things that can make it a little bit more challenging to get out of. So trusts are a bit more rigid. But that's when you have like a lawyer come in and they're like customized, almost like your will, right? It's like floating with the same line. And the last piece I'd say is expatriates. So like if brothers want to live or sisters want to live overseas, like in a Muslim country, and work there, the first 110,000 is tax-free of your income. So you are taxed on worldwide income, except if you're an expat. Then it's because they assume that your country that you're in is taxing you. Well, some countries, like Emirates and other places, they don't have taxation, so it's tax-free income, and they don't include the housing and stuff like that. Other benefits that you might get, they exclude it. And then there's a couple other things. Most of it is interest-based, so this institution of our government, IRS, rewards people being in debt, paying interest, and receiving interest. It's one of the only ways. So there was a man who said, I want to make $1 million a year, tax-free. He told his tax advisor that. He goes, okay, we can do that. So how do you do it? He goes, okay, give me your money. I'm going to buy municipality bonds. Municipality bonds are like schools, roadways, construction projects. So how do they get the money, right? Individuals lend them the money as a bond, and then what they get in return is tax-free income. It's one of the only ways that I know that you can have tax-free income is through interest from the government. Okay. So my point here is that this whole, and then when you get as deductions when you own homes, we call it profit, right, in some Islamic options, but it looks exactly like interest, and they did that intentionally so that you get the same benefit. But my point here is that the whole institution rewards being in debt, receiving interest, and paying interest.
Hassan, can you talk about how does college, are you talking about the 529 college savings?
Yeah,
how does that tax avoidance, like?
So it's deferring the taxes. And then it grows tax-free. And then as long as it goes for a certain purpose, the problem with the cover down, things like that, and you can do it by different states, is you can't like say, hey, I want this to go to my knowledge, to go to an Islamic option. Like they have their own funds. And when I looked into some of them, they were a bit problematic as an option. So I would advise looking at other more halal options with the same intent. All right, are we good on taxes? I said it was going to be half an hour, so I'm not doing too long. So I'm trying to run through the rest of this. Okay, what's the difference between income and wealth? No one knows.
Income's how much you make, wealth is what you own. Stuff.
Yeah.
There you go. That's a good definition.
Right. You can make a lot of money and be bankrupt. Right? My friend, who worked next to me in the cubicle next to me as an accountant, he's like, the problem is that my wife's credits are more than my debits every month. Right? Like, my paycheck coming in doesn't offset the amount she's taking out every month. Right? So he's never going to get any wealth because his income doesn't offset the outgoing amount. So, but people who are wealthy could have low incomes, but their lifestyles are what drove their wealth. Okay, meaning they live simply, they can have steady incomes, and they can put a lot into savings, or they can invest it, but they don't use it. Right? They don't need to drive the fanciest cars and the nicest phones and all those sorts of things. So there's actually demographics to that as well, between income levels of like African Americans and Asians and etc., whites, versus the actual wealth. So what they found is, yeah, the income's not as wide sometimes, but they don't have any wealth. Meaning that the income disparity is there, but the wealth disparity is greater. Like they have no equity in anything, some of the minority communities. right? And then it gets into like some of the institutional racism, stuff like that, about how they spend and how they're nurtured to spend what they bring in. So that's the difference between wealth and income. Net worth, interesting, there was a sheikh who visited, I'll never forget this, and he was from South Africa. But he said, your net worth is your net loss. Then he clarified, I was like, what he's saying is that your net worth is the difference between what you own, what you owe is your net worth, right? So if I own a house for $2 million, but I owe $1 million in mortgage, my net worth is $1 million, right? Like I don't actually own something that's $2 million because I owe $1 million to the bank or to another Islamic organization for that. So my net is the difference, okay? So some people have cars and have tuition debts and all. So you add up all your debts, and then you add up all your assets, and the difference between those is what you actually owe. Does that make sense? So that's how I'll tell my kids all the time, like, yeah, like you see all these nice cars and nice houses, and boats, but people don't own what you see, right? So for example, student debt is $1.2 trillion. One of the highest bankruptcy rates are 25 to 34-year-olds in America. So what you see isn't what you get, right? That people just live in debt as a culture. So net worth, what he's saying, is your net loss, meaning that you're going to visit your grave and you're not taking anything with you. So anything that you left behind, maybe for your heirs, but it's your net loss. That was his point. You're going to lose everything. So you actually have nothing. So as Muslims, I know we get caught up in the culture, right? But like we need to be mindful of where we're ending up as it relates to money. And active versus passive is just, do you have to earn this by day, by hand, by action, by time? Or is this just, I made this investment, let's say cryptocurrency, whatever it is. I shouldn't encourage cryptocurrency. You bought a rental property, right? I don't have to do anything. I have a property manager, and all I do is get our Airbnb, right? Or I bought a car and I have somebody else manage it and I get a 10% cut. Right? That's just passive. I don't have to do anything with it. Active is what I spend my time, my energy doing. And so those are two different things and they're taxed two different ways. And the last piece, just financial statements, just from literacy perspective. That might be hard to see, but this is what corporations publish every quarter. So you know how they have earnings release? So there's three primary things, but it's a balance sheet. A balance sheet is my assets of the company, my liabilities of the company. The difference is my equity, right? So I have this company's example. They have 149,000, and then they have some property. So they have 470. I don't know if you can see it, but they have 472,000 in assets. But they owe 247,000 in liabilities, like payroll, for example, right? They have payables to other vendors. And so the difference is 200,000, and that's essentially your equity, your ownership of the company, okay? What happens is, if I just start a company, there's $100,000 in cash, I have $100,000 in equity. There's no income yet. When I have income or loss throughout the year, that's what dictates my equity. My equity goes up as we make money. I lose ownership as it's less than $100,000, because that's what I put in. So I have negative equity in the company. Make sense? So you build up your equity and ownership as your investment turns a profit, and then you have more assets than liabilities. Okay. The income statement, so this is a snapshot though. Whenever you see a balance sheet, as of this date, this is what I own, and this is what I owe on this date, okay? Whereas an income statement, here's what I sold, here's what it cost me to sell those items, here's some other expenses, and then here's my profit, right? That is over the course of a year. That's an income statement, got it? So balance sheet, date and time. Income statement is over a period of time. So over, let's just say 2024, how was my business? Here's what I made in revenue, here were my expenses, and here's my profit or loss. But it's over the course of 12 months. And then here, we don't even care about that, that's just cash flow. Where did my cash actually go? Because in accounting, I could buy cash, I have cash, I use it to buy machinery, right? My cash went out, but I don't have an expense. I just bought one asset, I used one asset to buy another asset. And my hope is that I can use that asset to make more money, right? So there's a difference between cash coming in, cash coming out, and expenses. All right, that's enough accounting. Investing. This is if you don't buy a latte, the green chart. So if you forego $5 for your coffee every day and invested it every day, this is what it says, right? So $5 a day over the course of time, these are years on the bottom, that's how much money that $5 latte would get. I have a cousin, he goes, every decision I make, I look at how much it will cost me over 3 years. And then I make a decision. So his is like, if I look at it $6 or $5, well, coffee now is ridiculous, it's like $7. But if I look at it like, if it's one day, it doesn't feel too painful. But if I say, okay, 1 day, 30 days, it's 12 months, 5 years, or 3 years, like how much, and he's like, oh, that's $7,000. No, I'm not doing that. And so he makes a decision today based on the cost over 3 years. Same for internet services, same for yard services. Will I do it myself? Or will I pay for it? But he makes that decision because this is the opportunity cost. So I can either lose, let's just say $7,000, or if I invested it, I could make $100,000, or whatever the delta is over a period of time. So that's the opportunity cost of consumption today. And this gets into the wealth versus income aspect. Off to the left is if you put $1 in any of those indices, what would it end up being 90 years down the road? Right? So it's like $1 turns into 16,000 or 4,000. Just depends on what stocks or indices you buy, S&P 500, etc., NASDAQ. But the point here is there's always growth over the long term. Some people get lucky and buy NVIDIA, right? But like generally people, hold it and don't be emotional. Okay? Our company, there's a time when we did a matching program, but it was $155 a share, and then it went down to $79 a share. That hurts, right? But what happens is you bought it 155 and it went down and went down and went down, and you're like, I should just sell this, right? Well, what happens is it goes up, 79, 80, 155, and it goes back up, but you bought it all the way back up, and then it goes above that, but you bought it at 79, because you bought it every single month, right? So then it goes up to 150 or 200, whatever it's going up to, but you bought it along the way, and so if you're emotional, you would have sold everything and walked away, market sucks, I'm never doing this again, right? Let's keep clipping coupons. But if you were unemotional about it, you're like, let's just ride this out and be consistent and buy on the average, right? And so that's what this graph is showing over here. This last piece here is inflation. So the consumer price index is, if you don't do anything with your money, like some people aren't comfortable with certain investments, okay. But just know that if you have your cash sitting in an account in a bank, they're lending your money out and getting interest on it. That's one aspect. The other aspect is you're losing like 5 to 8% of the value every year because of inflation. So at least do something to offset the inflationary effect of cash just sitting around. And don't fund the bank to finance interest. Okay, try to avoid that. This is going to be real quick. Okay, so budgeting, why do you need a budget? You might not. Like, if you got a good handle over your expenses, or like you have no expenses, or you don't need a budget. But if you have certain ambitions that you want to do, and save money on the side to buy a car, to buy whatever, buy a home, then you probably need to have some sort of plan to reach your financial goals. The difference between a budget is usually budget, I do that once a year, that's my budget for the full year. What you do with forecasting is halfway through the year, or a quarter of the year, you revise that budget and you reflect what you actually think is going to happen for the next 9 months or next 6 months. So forecasting is a bit more dynamic. Budget is usually fixed for a period of time. The third point here is stretching, like living beyond your means versus kind of stretching. So I think there are certain points where like, hey, like this is a risk and I need to stretch and I need maybe another $5,000 or $10,000 to buy this house, to buy this car, but I'm going to use it for an investment. So I think there's a balance between living within your means, but also being aggressive. So like sometimes it's hard to buy a home if you're not all in. Like, you have to be very aggressive sometimes to buying a home now, and you might need to borrow $5,000 or $10,000 or $15,000 or $20,000 from a friend with an agreement to pay him back over time. So that's kind of living out because you don't have the cash. But if you don't do certain things like that, you won't be able to jump in and be aggressive or assertive about the investment opportunity. So there's, I guess, be practical about the situation and the likelihood that you'll be able to get out of your limits, because no one likes to be in debt in the first place, let alone debt to multiple agencies. So like a debt to a friend and debt to a bank. And then the last piece is just financial goals. Is everybody has different goals. Some people don't even care about finances. Like, listen, I don't need much to live. Right? I just listened to a talk about Sheikh Hamza. He's like, I lived in the desert for 7 years, and I realized how much I don't need. Right? And so financial goals are different. But I think one thing we've learned recently is Muslims need to be economically strong, right? That we can't, like, there's obviously minority communities that make up 1 to 2% of the population, but they control the vast majority of the wealth, right? And so with that economic power, they're able to do a lot of things that are entirely antithetical to Islam. Okay? So Muslims need to have their own infrastructure, need to have their own institutions, and need to have community members who are, rulers who can fund some of this stuff, right? Like in places like I was studying, or I was visiting, they have the scholars and they have the traders. And so when they want to go on dawah trips and stuff like that, a lot of that's funded by the businessmen. South Africa, the same thing, right? Muslims have a strong presence because they're very successful businessmen, but they have funding of the devs as well. So we need to be able to have that, maturity as a community where we're economically strong and independent, and we can't be dictated by landlords. Whenever you're under a landlord, you're under somebody's foot. So that's in terms of the financial goals. Any questions? Sorry, I went over, I said half an hour, let's see if time to but I went 45 minutes over. Yes?
Yeah, may Allah reward you for your knowledge that you're sharing with us. But you were talking about contributing to like an IRA or a Roth. What is it? What advice could you give to like companies that may want to provide this service for like employees? Because like a lot of Muslim organizations, I don't know, the ones that I'm around don't really offer that to the community. So what would they get out of offering that to their employees?
Who would get?
So when you, because some companies offer a 401k, right? So how can like Islamic organizations get into
Easy. So I'm a trustee on another organization, and what we do, and we did this for 5, 6 years, because there's a senior sheikh in our community, and I just, where's his benefit? Where's the community give? Like he's just getting older, and we've seen that play out. They're just getting older. You can just see it. It's harder for them to stand up and ruku and sujood. Like you can see it. So where is their benefit that's going to help them out in their elder years outside of just Social Security? So what we did is we said, okay, every year we're going to give 3% to the religious scholars. So your salary, let's just say $100,000, right? So we say, okay, every year we're going to give you $3,000. Take that $3,000. It'll look like a bonus, but when I do your tax returns, because I do it for them, that's what you put into an IRA. And so that's how we do it. We say it's a percentage of your salary, and every year we're going to give you that amount. Now what's on you is to put into your IRA. You can put more, but you have to at least put $3,000, then it's tax-free. And so what we're doing, if you've done it for the last 10 years, and then invested, and it grew, you might have $50,000 in an account that you're not touching, and because this organization had this one thing where they said 3% of your income, or your salary is going to go to this benefit. So that's actually what we do. So it's an easy way to do it, and I would encourage all organizations to look out for their scholars to do something like that. And you can get the same benefit, right? And essentially you're giving a match. That's what we're talking about. You're matching some income. And they can put more in it, but in our case, we just give a percentage of your salary. Yeah, so I think it's important that this is the maturity thing, right? Muslim institutions need to, in some ways, be on par with the benefits that they give, especially to the imams.
How about like a sponsored one?
So the problem with sponsored ones is it's a lot of admin. It makes sense when you have 500 employees. But this is why we did it this way. We said, okay, just one check, you open up your own personal IRA, you take that check and you put it in there. No overhead. And then when I do your tax returns, I know we gave you $3,000. I better show you at least put $3,000 into your IRA account as a deduction, because then it becomes tax-free. But whenever you do those sorts of like plans, it becomes heavy on the overhead. It doesn't make sense for 2 or 3 people.
I think that was one of the main questions, right? Sponsorship.
kind of.
Yeah, I would put it on the individual. You can give them the bonus, but you don't.
So if you're a small organization,
yeah, don't create a plan because it's much more expensive to do that and to maintain it and have a 401k administrator and all these sorts of things. It's not worth it. This is like the low overhead, same effect. The other thing that I wanted to mention, I failed to mention, it's kind of interesting, is financial abstraction. You guys know what that means? Especially with kids. You guys in the back. You guys in the back and forward. You know your name. He's really into it.
Ali.
Don't worry about it. He's good. Financial abstraction is the disconnect between coins and cash and currency, actual and digital currency. So what they found, for example, is we all have credit cards. You spend 12 to 18% more when you use a credit card versus cash. So if you want your wives to spend less, just give them cash and not a credit card, right? Because you're more, you yourself, right? You're more conscious. When you see the $100 bill, you're like, ooh, you feel it, right? The 50, you feel it, right? My son, they don't feel it when they click a button. Right? Amazon, like, okay, it's coming tomorrow. Like, they don't feel the $20. They don't have any sense. Like, it's all the same experience. When you swipe a card, if it's 5,000 or 500 or 5, it's the same exact action. And that's why there's a huge push in psychology to 5% back and 2% back. It's because you're not getting it back. You're spending more. They know that. So financial abstraction, this TED Talk is talking about, my kids had a certain behavior when we played Monopoly. Monopoly, right? You go around the board and you buy properties and you charge rent for them and people land on them. Because it's not real money. The problem is, he goes, I actually got $10,000 in cash and they dished it out, $1,500, and it became very real to them. And the winner got a certain amount of money, right? But what happened is their behavior of how they play Monopoly changed. Because they went from a financially abstract idea to cold, hard cash. And when you have cash in hand, the way you look at money differs. And the decision you make differs. So his point was our children need to understand, because there's real life consequences to living in a fantasy. Like, you get coins deposited and you just use coins on your phone or on your watch or your whatever, right? It's just not real. It's digitalized. And so you don't actually feel the experience of the cash, but there's real consequences to it. So what you're suggesting is teach your kids, give them an allowance, give them real money, and let them feel what it's like. Say, okay, your school shopping's on your own. This year you got $200. Use it. It's up to you. But it's up to you, right? You overspend on your backpack, then you're not getting your own. Like, whatever. Like, you need to give them some structure. But the point was giving them life experiences so they can make small mistakes now because they know how to manage money then. Right? So that's the idea of financial abstraction. There will continue to be a push to make things easier and quicker because they just want you to spend freely and not differentiate between the value of the money. And very few people know that spending with cash, specifically. Right? Asia's the same way. Does that make sense, the financial abstraction piece? So when you think about with your kids, think about lessons you learn, and what you learned when you were a kid about working and getting paid. Like, getting paid with money, like, that's a real thing. Something you can touch and grab. But when it's getting paid, it's a deposit. It comes in and out, you never touch it, never feel it. Like, it's abstract. All right, that's all I'll say. Okay, any other questions? We've gone way over.
Everyone.
Yeah.
I don't know if you're comfortable with talking about it, but like investing in like by indexes, like VOO and whatnot. Like what is that? How do you make it halal-ish, or what is the different rules? Yeah, like.
So I can tell you what I do. I'm not giving you like a fatwa or anything, but like, so at one point, and my company kind of half does it now, but they say, okay, we have these funds for your retirement. You can only choose these 12 funds. Yeah. So I go through each one of them, the stock symbol, and I say, what is the most Islamic option I have here? Right? So what has no interest, no bonds, right? Or the least amount of financial institution to invest in. And so I generally, even if it's not the best performing one, I'll pick like the top 2 and just put half and half. Right? So that's kind of the same idea. It's specific mutual funds that you can't control, that you're only allotted. So which ones do you choose? I choose the best options of the worst, the best options of what's available. In terms of like indices and stuff like that, like Amana, for example, I talked to Munim, who does it for Amana up north. I was like, I don't want to invest in Google. I don't want to invest in Meta. Like, I don't want to invest in those companies. But their funds, like, there's no way to avoid. Like, well, if they're funding the Israel army in some way or shape or form, we'll take them out. But like these big companies, like that's part of the NASDAQ, S&P 500. And so I don't think there's a way around that if you want to avoid specific stocks. Like Wahed, Amana, and Amana's got different versions of it. They're kind of all invested in the same big companies. If you look at their top 10 holdings, so that's kind of hard to avoid. I don't invest in like indices, for example. I usually pick specific stocks, right? Like, okay, I'm comfortable with, let's just say it's like Taiwanese semiconductor company X, right? They make semiconductors. I'm comfortable with that, right? I'm not comfortable with Meta and Google. I'm not comfortable with those on an ethical, moral perspective, right? And some people might not be comfortable with Amazon or Microsoft, right? So people can differ. But me personally, I like to pick individual stocks outside of scenarios where I maybe don't have such a choice with like the 401k option. So in our case, yeah, I have like Wahed as one, right? Which is essentially like S&P. It's got entitled indices, but they have an Islamic twist on filtering out those. So that's like as close as you can get. So that's what I do for that. Yeah.
I also have a question. You know, you were just talking about budgeting. I feel like that's something to think forward to because, you know, speaking from personal experience, you know, I'm a college student and sometimes it be hard, you know, to budget your money. Like you gotta pay for food, you gotta pay for, you know, like your books and, you know, tuition. And you also gotta, you know, save money for other stuff. Like, cause, and I know like this say financial aid gives you money and you're also trying to figure out like how much money should I spend for food on a weekly basis, or like let's say like I wanna you know like save up for long-term saving, and it's kind of hard to start because you don't like you want to save money because you feel like you're eating up your money, yeah, and like you said about like you said earlier about like how you use the credit card. I mean, like if the more you use it, like the more impulsive choices you make, and I want to focus on, like thinking up a way to like save up that money and not let not use that card.
Yeah. Yeah, so my advice, so the question was about budgeting.
Yeah, exactly.
And how to have discipline over budgeting.
Yeah, exactly.
Right, and you have the cash at hand and not just use it. So my suggestion is open up another bank account or open up a brokerage account and just put money. So every month I'm gonna put $200 in. Right, when you start working, you can make an auto deduction, but if you have it out of sight, out of mind, it'll be less impulsive to dip into. You're a college student, so you probably, it's a little harder because it's fluid. You have your tuition that you have to pay, you have school and other things. But if you're working, my suggestion is start putting money, open an account, even if you start small, because if you fast forward to like 10 years or 15 years from now, right, you're gonna have something that's saved and accumulated over time.
Yeah, exactly. And I also want to work on, like working on the bank account. That is completely interest free.
That's easy though. That's easy. You just tell them that you don't want, I don't want a savings account, right? So that's pretty easy. But just keep in mind, if you just have cash accumulating in an account, then it's just getting inflation, right? So I would look for some sort of Islamic halal option. There's actually, I'll tell you one thing. There's a Brothers it's Provision Capital, I think, in Texas. I'm not on the board or anything. It's just a good business model that generally returns 10 to 12% every year. What they do, and I talked to the founders in Texas, they just buy homes. So you put your money in a fund, they just buy homes, they flip them, and they sell them. That's all they do. And one part of the profits from doing that, they put it back into the fund. And so the brothers who put $100,000 in are seeing that they're getting $10,000 return at the end of the year. Right? So the point is you have Muslims who set up something where they're just flipping houses, and they find out flipping houses is much more profitable than trying to rent them out. They used to rent them out, and they realized that wasn't a long-term investment. So they flip them, and they sell them to institutional investors. So they do it within like the Houston, Dallas triangle area. But my point is, there are things that you can do. I don't think there's a minimum, but if you put $1,000 and you put into something like that, right, with a 10% return that you feel comfortable with, there's a brother who's like, I don't like stocks, I don't trust him, I don't believe in him, I don't want to do it. He's one of the old school guys in our community, but he does this, right, because he feels it's nice and clean, right? And he's been doing it for years, and he does usually the returns are about 12%, right? They're consistently every year. So that's just an idea. We can think about these options as ways to preserve our wealth.
Talk about avoiding taxes. What are some of the strategies that you would recommend?
So I listened to some of them.
It's another lecture.
Yeah,
It's a one-on-one consultation.
I would say I think setting up a business, like having more entrepreneurial spirit, setting up businesses so that you can now have your home becomes an expense, your electricity becomes an expense, your rent, your mortgage, your insurance, all that now becomes a business expense. So if you have W-2 income, let's just say it's $50,000, but then you have this home expense, maybe you don't make any money, right? But you've got these expenses from things that you bought maybe, right? And so what happens is you can offset this W-2 income by these business expenses that you incurred. It can be mileage based, right? It can be buying the car and appreciating it. But these are the types of things you can do. So business is a big piece of it. Getting income from like non-qualified dividends, which are essentially capital gains, is another piece of it. But W-2 income by itself is hard to avoid taxation. Virtually impossible.
Would you recommend a business over nonprofit, setting up a nonprofit, or nonprofit over?
Nonprofits aren't designed to avoid taxation. Because not-for-profits, no one can endure the benefits. So when a not-for-profit goes bankrupt, what happens is it has to give all of its assets to another not-for-profit. Right? It can't go to an individual by definition. And so I would recommend a not-for-profit. You can set up a not-for-profit if you say, like, I believe that people in the champ community need to have an education, right? And I want to provide this free service or whatever. So you can set up a not-for-profit to carry out a mission that you believe in. And you can funnel your money through that, as opposed to just paying taxes and paying out of your pocket. At least you can funnel through a not-for-profit, get corporate matching, get a deduction, all these other things that go with it. So that's more for certain purposes, like charitable, like education, like religious, scientific, but not-for-profits are for specific purposes, not as tax shelters. Not to say people don't use it for tax shelters, because they, instead of just giving my family overseas, I'll just funnel through my not-for-profit, I'll get a tax deduction, I'll send it to Auntie Susan or whoever the lady is, right? Like, people do channel to not-for-profits, right? You want to hear an interesting story? We have time. Is it intermission time?
Yeah, sure.
Okay. You guys know what the IDF is, right? Yeah. Okay. True story here. Like, this is messed up. So I work for a company, and a tech company, and I looked at our matching policy. And one thing they won't match, so they'll match equal relief, but they won't match ICOR. Why? Because you didn't designate that you're an X, which is religious organization. You must have put that you guys are charitable, philanthropic, humanitarian, right? Really. So our company says if they mark X as religious, you will not get matching. Okay? Full stop. You will not be eligible for matching. However, if you mark some other thing, you can be, as long as you're not political, not religious, you can get matching. So, there's one organization that bothers me. It's called Friends of the IDF. Right? So what they do is, our slain warriors, this, that, and the other thing, we're going to get them back into life and help them and give them money. So, if you know, the IRS, the only two countries that you can set up a not-for-profit for outside of America is Mexico and Israel. So you can set up not-for-profits in those here for those countries and get a tax deduction for your American money for money you're giving to Israel. Right? And you set up these shell not-for-profits, right? Because what are these doing? A lot of these are enabling settlements. Right? They frame it with the words that you would expect from a not-for-profit on the front end, but on the back end it's a Trojan horse, right? And so I wrote our corporate social responsibility department. I go, how is it that you will not allow me to give money and you will not you will not match and fund organizations that are charitable, that are religious, that are doing life-saving work, but you will allow me to fund and you'll match corporations that are taking the lives of children. And I said, here's the link, here's the ICJ, here's the videos of they themselves that they recorded. Most of it's somewhere in Monterey, right? But they obviously put a lot of other stuff out there. And I go, so how is it that you will match and give your money to this and not that? And it takes some perseverance, but they're like, well, look into it. And so what ended up happening is they got banned from being matched, the Friends of the IDF, for our company. And they actually changed our matching policy in North America so any military or any organization involved in the proliferation of armaments, of weaponry, right? They will not be eligible for matching on the platform. And they actually said that organization is under an investigation by Benevolent and might get banned from the entire platform, right? But my point is that one is we all have to have a voice, right? Like you can point out the inconsistencies in the policies that we have, even in corporate America. What was nice about ours, they actually took action, right? But there's a lot of IDF things, right? That was just Friends of the IDF, which is a prominent one. There's another. So my point, when you're asking about, do I set up LLCs or not-for-profits? They obviously use these companies because they want the corporate matching, they want these other things, and they set up as shell not-for-profits and look that way on the face, but on the back end, how they're using the money, right? So I wouldn't obviously encourage us doing that.
Have you ever experienced somebody opening a non-profit for funding youth? Funding the living because everything's so hard.
Yeah.
So what they do, they put their home as a non-profit, so they don't pay taxes.
Yeah, it's the same thing as a car.
Yeah.
You can gift whatever you want for taxes or for not-for-profits, right? There's a fair market valuation to that, right? You can gift a car, you can give stock, you can give cash, right? You can give assets not-for-profits. And there's no problem, as long as it's humanitarian, it's philanthropic, it's charitable, it's scientific, it's educational. There's like a list of 5 or 6 things that are 501c3 eligible. No problem at all. So we can be creative in how we utilize, and then you're eligible for grants, and then you're eligible for matching, right? So there's ways we can be smart about using the system for our advantage that's completely legal and compliant. What we shouldn't do, as I said earlier, is give cash if we can avoid it. Do it through these avenues at least. Does that make sense? To the extent, but we have to have the infrastructure set up such that we have these in place for these avenues to give and to have the impact in the community, inshallah. Khair, yes?
About the 401k, yeah, with the company, maybe the 401k is good. When you start working, the money is sitting there, and if you want to take it, they're going to tell you, oh, you have a penalty, this and that. They're going to ask you to wait a certain age. When you wait that age, when you take out the money, then you have to claim it as the income. When you, if you, like, I think you said it earlier, if you forgot to claim it, the IRS is going to come after it. You didn't claim this money. Where is the benefit of it?
Lots of benefits. Good question. So the question was about 401k. There's some things like you have to wait till you're 59 and a half to get it out. If you take it out beforehand, there's a 10% penalty. Then also you have to pay taxes on it. So what is the benefit of a 401k? Typically, the benefit is your employer, for some of these companies, match it. So if you put in $1, they'll put in 75 cents. So automatically, you've already had a 75% appreciation right there. Assuming it doesn't take time to vest. So if there's a match element to it, it automatically makes sense. Even if you were to take it out, get taxed on it, pay the penalty, you still profited. So that alone tells you that it's worth it. That's the first step. The second step is you've deferred paying taxes on it. The third thing is a lot of these companies that have 401ks will say that you can take the money out for these 10 reasons. One of them is medical expenses. One of them is education of your children. One of them is home. One of them is a financial hardship. And you can say, okay, I'm going to pay that back over 5 years, right? And so there's flexibility, and each one's a little bit different, each policy, but it's not like you can never touch the money, right? You can actually have access to it for a handful of reasons, and sometimes there's no reason at all. I just want a loan. I just want the money today, and I'll pay it back. But again, you're taking it out against money that your company's giving you by matching some of it. So that's the immediate benefit. It always makes sense, even if you were to liquidate it the next day, because they're matching it. If they don't match it, then that's a different discussion. And then you say, is it really worth it? Maybe not. But that's where it's personal. But usually because of the matching element, it makes sense. Anything else? You guys in the back good? You guys got the whole spending money, transactional abstraction, financial things? Okay, use cash. All right, Jazakallah khair, barakallahu feekum. Thank you for the time. We're going to have